Okay, so when you hear the word trading, what's the first thing that pops into your head? Is it that crazy scene from a Wall Street movie, people yelling and throwing papers around? Or maybe it's those super complicated charts that look like a heart monitor going haywire? It can all feel pretty intimidating, right? But what if I told you that at its core, it's actually incredibly simple? Let's just strip away all that noise for a minute and get to what trading really is.
A ton of people think trading is basically just a big casino, a high stakes guessing game where only the insiders ever really win. They figure you just pick something, cross your fingers, and hope it goes up. But honestly, that is one of the biggest myths out there. Because when you boil it all down, trading is just this. You buy something at one price, and you sell it at another. That's it. That's the whole game. The space between those two prices? That's either your profit or your loss. Every single fancy strategy, every chart you've ever seen, all of it is just trying to help you make that one simple decision a little bit better.
So, how does this all work on a global scale? Well, to really get a handle on the world's biggest markets, let's start with something you probably already understand perfectly. Just picture your local farmer's market on a Saturday morning. You've got people coming together to buy and sell stuff, right? Let's say tomatoes. Now, the price of those tomatoes isn't just made up. It's set by two really simple forces that you already get, even if you don't think about it. And it all comes down to supply and demand. I mean, think about it. If everybody wants fresh tomatoes for a salad tonight, but the farmer only has one crate left, what happens? The price is going to go up because people are willing to pay more. On the flip side, if the farmer has mountains of tomatoes but only a few people are buying, well, he's got to lower the price to sell them. The price goes down. Simple. And here's the secret. That's the exact same logic that drives all financial markets. Whether we're talking about stocks, gold, or crypto, it's really just a giant digital farmer's market. Instead of trading tomatoes, people are buying and selling assets. And the price moves based on one thing: how many people want to buy versus how many people want to sell. The principle is identical.
So, what are these assets people are trading? Well, there are a few many types. You've got stocks, which are just tiny pieces of ownership in a company like Apple. There's forex, which is just treating one country's currency for another, like the US dollar versus the euro. You have commodities, which is real physical stuff. Think gold, oil, even coffee. Indices let you trade a whole basket of stocks at once, like the S&P 500. And of course, there's crypto, like Bitcoin. Each one is just a different kind of tomato in its own specific market.
Okay, so we know what a market is, we know what we can trade, but what actually happens when you place a trade? Well, it turns out every single trade that has ever happened follows the exact same four-step cycle. You can almost think of it as the heartbeat of the market. So here's how it works. Step 1, you choose. You do some research and decide what you want to trade. Step 2, you enter. You hit the buy button, and now you're in the market. This is called opening your position. Step 3, this is the tough one, you wait. The price starts moving around, and this is where your emotions really get tested. And then finally, step 4, you exit. You sell the asset, which is called closing your position, and you're out.
And what's really kind of cool is that this four-step cycle is universal. It doesn't matter if you're a total beginner trading with $100 on your phone or some giant hedge fund in a skyscraper trading $100 million. You still have to do the same four things: choose, enter, wait, and exit. Those fundamentals never ever change. All right, now to really see why this isn't just about luck or gambling, let's look at a super practical example. We're going to follow two different traders, Jamie A and Jamie B. They're going to start in the exact same spot, but we'll see how one little thing, having a plan, changes absolutely everything. So let's meet our two traders. On the left, we have Jamie A. We'll call them the hopeful. On the right, we have Jamie B, the planner. Now, they both see Nike stock trading at exactly $100 a share, and they both decide to buy 5 shares. So right now, they're in the exact same trade at the exact same time. The starting line is completely identical. So they both enter the trade, and the market does what the market always does. It moves. The stock price quickly jumps up to $108. Awesome! Then it pulls back a little bit, then it rallies again, and this time it shoots right past 110. And then, just as suddenly, it takes a nosedive, and the price falls all the way down to $94. This is that emotional wait phase we were just talking about. So, what happened? Well, Jamie A, the hopeful, got really excited when the price went up, but then totally panicked when it dropped and sold everything out of fear at $94, locking in a $30 loss. But what about Jamie B, the planner? See, Jamie B had a rule before they ever got in. If the price hits $110, I'm selling. So when it hit that target, they sold just like they planned and walked away with a $50 profit. And that right there is the entire lesson. It was the same stock, bought at the same price, going through the exact same price swings. The only thing that was different was the preparation. One of them was just reacting emotionally to the chaos. The other was calmly executing a plan they made when they were thinking clearly. And this really gets us to the absolute core idea. The one thing that separates disciplined trading from from just hoping for the best. See, real trading isn't about predicting the future. No one can do that. It's about having a plan. It means you've decided on 3 things before you ever risk a single dollar. You know where you're getting in, you know where you're getting out with a profit, and this is the important one, you know where you'll get out if you're wrong to limit your loss. That's it. That's the whole game. So that really leaves us with one final question to think about. If you go into the market without those rules set in stone ahead of time, are you actually trading, or are you just closing your eyes and hoping you get lucky?